Welcome to the Byte-Size Brief. Today we are putting AVAV completely under the microscope. Let's get into it.
Yeah, this is going to be a fun one.
It really is because if you were watching the markets on June 30th, you saw this just incredible paradox unfold in real time.
A total contradiction.
Right. On one hand, you've got this company that doubled its quarterly revenue, totally shattered Wall Street estimates, and, saw its stock explode by up to 34% in after-hours trading.
Which is massive for a company of this size.
Massive. But then, in the exact same breath, they confessed to these staggering accounting errors, admitted to losing over $250 million on paper for the year?
Yeah, quite the plot twist there.
I mean, seriously. And then they warned investors that their cash flow was about to go negative, so it's just wild.
It is. It's a phenomenal contradiction. And, to understand how a company can be wildly successful out on the battlefield while simultaneously setting off all these alarm bells in the accounting department, we kind of have to recognize what AV actually is today.
Right, because they aren't who they used to be.
Exactly. The market, I think, still wants to treat them like this plucky drone startup.
Yeah.
But that era is over. Right now, AVAV is arguably the closest thing the United States has to a pure-play autonomous defense prime.
So they're playing in the big leagues now.
Very much so. They are rapidly scaling from just a hardware vendor into a highly diversified, heavy industrial defense tech platform. I mean, we're talking space communications, cyber warfare, directed energy, and, of course, highly advanced loitering munitions.
Which is exactly our mission for you, the listener, today with this deep dive. We are going to completely unpack the mechanics of this transformation.
There's a lot to dig into.
There really is. I mean, how does a company pull in $641.6 million in a single quarter, which, by the way, is up 133% year over year, while navigating class action lawsuits and this brutally expensive physical scale-up?
It's a tough balancing act.
So let's start with that revenue number, because capping off fiscal year 2026 with $2 billion in total revenue is just a formidable achievement.
It's a huge milestone.
And the autonomous systems segment alone pulled in over $492 million of that. So I guess, what is the fundamental mechanism driving this specific demand?
Well, it really comes down to a profound shift in military doctrine. It's moving toward this concept known as intelligent mass.
Intelligent mass. Okay, break that down for us.
Sure. So for the last 40 years or so, the Pentagon strategy was built around exquisite, highly expensive platforms.
It's like the big flashy stuff.
Right, exactly. Think of a $1 billion stealth bomber or, a $2 billion guided missile destroyer. The problem is, if an adversary shoots down one of those platforms, it is a catastrophic financial and strategic loss.
Right, you lose one, and it's a huge blow.
Exactly. So the new doctrine dictates that future warfare is won by deploying thousands of low-cost, AI-guided, attritable systems.
Wait, attritable being the key word there. It doesn't mean disposable, right?
No, not disposable.
It just means it's cheap enough that you can afford to lose a few without completely ruining your military budget.
Precisely. You essentially overwhelm the adversary's air defenses with sheer volume and autonomous coordination.
Gotcha. So it's a numbers game.
It is. If an enemy has to fire a $3 million Patriot missile to shoot down, say, a $50,000 AVAV loitering munition, the enemy loses the financial war of attrition.
Even if they hit the target.
Right, exactly. Even if they hit it, they lose financially. And programs like the Pentagon's Replicator initiative are these huge structural tailwinds. They're designed to bypass traditional procurement and rapidly buy exactly what AVEs is building.
Which explains why they're sitting on, what, $2.7 billion in bookings?
Yes, $2.7 billion in bookings and a record-funded backlog of $1.2 billion. Their technology just perfectly matches this new cost exchange ratio.
But they aren't just selling the drones they built in-house anymore, right? I mean, the recent acquisitions of Blue Halo and Aero fundamentally shifted their whole product mix.
They absolutely did.
Because those acquisitions contributed $282.3 million to the Q4 revenue alone. So explain the why here. Why did a drone company feel the need to buy its way into space laser communications and cyber mission solutions?
Well, because in a modern, heavily contested electronic warfare environment, a drone that relies on standard radio frequencies is essentially just a flying brick.
A flying brick because of jamming.
Exactly. Adversaries have become incredibly proficient at jamming radio signals and GPS. So if your drone can't receive commands, It falls out of the sky.
Oh, wow. Yeah, that's a
It's
problem.
a huge problem. But Blue Halo brings highly advanced optical laser communications to the table. So instead of broadcasting a radio signal that anyone in the area can jam, a laser communication system shoots a pinpoint beam of light directly to a receiver.
Oh, I see. So basically, it's kind of like running an invisible fiber optic cable through the sky.
That is an excellent analogy, yes.
So unless the enemy physically puts an object between the laser and the receiver, they just can't block the signal.
That's right. It makes the communication architecture nearly impenetrable. And when you add in their new AV Halo command and control software,
Which does what exactly?
it allows a single operator to manage an entire swarm of these autonomous vehicles at once. So you can see the broader strategy here. AVAV isn't just building the Aero anymore.
They're building the bow.
The bow, the targeting system, and the secure communication network that guides it.
Okay, I love that technological vision. It's fascinating. But as an everyday investor looking at the bottom line, I have to ask,
Here comes the reality check.
yeah, I mean, if this technology is so revolutionary and they brought in $2 billion in sales, why did they report a net loss of $265.1 million for the full fiscal year under standard GAAP accounting rules? I mean, how does that happen?
It's a great question. And that net loss is actually the direct result of acquiring that technological vision we just talked about.
How so?
Well, when a company buys another business, like Blue Halo, they don't just acquire the cool technology. They acquire accounting burdens,
Ah, the boring stuff.
right? Specifically things like amortization costs and goodwill.
Okay, remind us what goodwill is in this context.
Sure. Goodwill is essentially the premium you paid over the actual book value of the company's physical assets.
Right.
So if those assets don't generate the financial value you originally projected when you bought them, standard accounting rules force you to write down that premium.
So it's not like they literally lost that cash in a briefcase somewhere.
Exactly. It's a non-cash charge, meaning they didn't literally lose the cash out of their bank account this quarter, but it absolutely eviscerates their GAAP earnings on paper.
Gotcha. And that perfectly brings us to the severe turbulence they experienced earlier this year.
Yeah, it was a rough patch.
Okay, so compared to last quarter, what actually moved the needle here? Because I remember in March, the sentiment around AVV was just incredibly bleak.
It really was. And to understand this June surge, we have to dissect the deep contrast between that Q3 hangover in March and the massive operational saves in Q4.
Okay, let's start with the hangover. What went wrong in March?
Well, back in March, management disclosed that a Space Force contract, known as SCAR, was canceled.
Right, I remember that.
And because of that cancellation, they took a $151 million goodwill impairment charge.
Ouch.
Yeah. But the CFO explicitly stated on the earnings call that this was the end of the story, and they didn't expect any further adjustments.
Which, given how volatile the stock has been lately, clearly wasn't true.
Far from it, unfortunately. 3 months later, AVAV had to issue a restatement for Q3.
Never a good sign.
Never. They discovered a calculation error by a third-party accounting firm. It involved tax attributes related to that exact same acquisition.
Oh, man. So how much did that error cost?
It added another $89.4 million to the impairment.
Wow.
Yeah, bringing the total charge to a staggering $240.7 million. But honestly, the dollar amount wasn't even the worst part.
Really? What could be worse than a $250 million charge?
Well, the SEC requires companies to disclose the internal conditions that allowed the error to happen in the first place. So this forced AVE to officially flag a, quote, material weakness in their internal controls over financial reporting.
Okay, let me stop you there, because financial jargon can get really dense. A material weakness isn't just a typo on a spreadsheet, is it?
No, it's much deeper than that.
It's more like finding out the ruler your engineers are using to build a bridge is actually 11 inches long instead of 12.
That's a perfect way to put it.
Because everything built with that ruler, every financial model projecting future growth, every single metric the executives use to make decisions now has to be completely ripped up, audited, and recalculated.
That is exactly the mechanism at play here. The internal processes designed to catch flawed math just fail.
Which has to terrify Wall Street.
Oh, absolutely.
Huh?
For institutional investors who allocate billions of dollars based on those exact spreadsheets, a material weakness creates a profound trust deficit.
I mean, yeah, you had a CFO confidently state a number was final, and then 90 days later it shifted by almost $90 million.
Right. And that dynamic is precisely why the stock was essentially cut in half from its earlier highs heading into this earnings print.
But they obviously bounced back. I mean, the stock jumped over 30% recently. So what were the Q4 saves that actually got Wall Street back on board, despite the accounting department totally dropping the ball?
Well, it comes down to the fact that the frontline operations delivered unquestionable results.
The actual business of defense.
Exactly. First, on the hardware side, the Switchblade 400 officially secured the Army's LASSO contract.
LASSO. What does that stand for again?
It stands for Low Altitude Stalking and Strike Ordnance.
Sounds intense.
It is, and this is a critical capability shift for the infantry.
Huh.
Historically, if an infantry unit encountered heavy armor, they needed something like a Javelin missile.
Which are huge, right?
They're heavy, they're expensive, and they require direct line of sight to the target. But the Switchblade 400 is a loitering munition.
So how does it work in comparison?
It can be launched, fly over a ridge, orbit the battlefield completely autonomously to find the target, and then strike the vehicle directly from the top.
Why from the top?
Because that's where tank armor is typically the thinnest.
Gotcha. So they successfully engineered a heavy armor-piercing warhead into a highly portable drone, and the Army is now officially buying it at scale.
Yes, exactly. But honestly, the financial save was even more critical than the contract win.
Really? More than a massive Army contract?
Yeah, because their adjusted gross margins bounced back to an impressive 34%. And more importantly, they printed $73 million in positive free cash flow for Q4.
Oh, wow.
Yeah, that was their first positive cash flow quarter since the very first quarter of fiscal 2025.
Wait, how did they manage that? Did they just stop spending money on research or something?
No, they didn't cut spending. They solved an administrative bottleneck.
What kind of bottleneck?
They completely streamlined the government acceptance testing process for their Switchblades.
Acceptance testing.
Yeah. In defense contracting, the government doesn't just pay you the second a product rolls off the assembly line.
That makes sense. They want to know it works.
Right. The military has to randomly select units from a batch and rigorously test them to ensure they meet specifications.
Okay.
But if that testing process is slow, the finished drones just sit in a warehouse, and the company's capital remains completely trapped in that inventory.
Oh, I see. So by speeding up that testing pipeline, AVA finally proved they could convert their immense revenue growth into actual cash in the bank.
Precisely.
Okay, so let me get this straight. The accountants are struggling in the back office, but the engineers are delivering flawless lethality, and the operations team finally unclogged the cash flow pipeline.
That's a good summary.
That sounds like they've really turned a corner.
Well, which brings us to the profitability paradox.
Uh-oh. There's a catch.
There's always a catch. Management issued their guidance for fiscal year 2027, and while they project continued double-digit growth,
Which is good.
guiding for revenue between $2.125 billion and $2.225 billion, and a return to positive GAAP net income, they included a highly concerning caveat.
Okay, what's the caveat?
Management explicitly warned that free cash flow will go negative again for the full upcoming year.
Wait, hold on. If they solved the government testing bottleneck and unclogged the pipeline, where's all that new capital draining to?
It's a great question.
I mean, why would cash flow go negative when sales are higher than ever?
Because AV is undergoing a sweeping, highly capital-intensive manufacturing pivot.
Oh, okay.
Their capital expenditures, or CapEx, is just skyrocketing to roughly 12% to 14% of their total revenue.
Wow, that's a massive chunk.
It is. And the centerpiece of this cash drain is a sprawling new facility in Salt Lake City called FreedomWorks.
FreedomWorks.
Yeah, and this factory is being built with a single goal, to pump out 14,400 Switchblade loitering munitions per year.
14,000.
Yeah, they're moving from producing just a few hundred units a month in their legacy California facilities to targeting over 1,200 units a month.
Okay, but building a factory to handle 14,000 units seems straightforward enough. I mean, Ford stamps out thousands of cars every single day.
Right, but it's different here.
Why is building a 5-pound drone specifically destroying their free cash flow?
Because scaling from a boutique tech innovator to a heavy industrial manufacturer is not just about bolting plastic together.
Fair point.
A loitering munition requires high-grade thermal optics, sensitive AI processors, and of course, explosive warheads.
So it's complicated.
Extremely. You need specialized clean rooms, automated test fixtures that simulate extreme flight environments, and strict government compliance checkpoints at every single stage of assembly.
That sounds incredibly expensive to set up.
It is. Before a single completed drone rolls out of FreedomWorks, AVAV has to buy 14,000 camera gimbals, secure the supply chain for tens of thousands of microchips, and train a multi-shift workforce.
Right, so you're buying all that stuff up front,
Exactly. That requires tying up enormous amounts of working capital in raw materials and factory infrastructure, months or even years, before the government actually pays for the finished product.
So it's basically the ultimate expense of growing pains.
Totally.
You have to build the machine that builds the machine before you see a single dime of profit.
Exactly. And while the market loves the vision of 14,000 drones a year, analysts are heavily scrutinizing the execution risks here.
Because it's a huge undertaking.
Right. And there are several shadow narratives hovering over this company right now that make Wall Street very nervous.
Okay, let's hear them.
First, there is the legal overhang. Following the March guidance cuts and the restatement of the ASCAR contract impairment we talked about, multiple securities class action lawsuits were filed against the company and its officers.
Oh, wow. Just immediately.
Immediately. These suits allege that leadership made false or misleading statements regarding contract transparency and financial guidance.
Which ties right back to our 11-inch ruler analogy from earlier. When the internal controls fail and the math is wrong, the lawyers immediately show up. And even if AVV settles, those lawsuits are a major distraction for executives, and they honestly put a ceiling on the stock's valuation.
That's true. But beyond the courtroom, we're also witnessing this fascinating shift in how AVE tells its own corporate story.
What do you mean?
They're quietly dropping claims they can no longer support.
Oh, like what?
Well, back in March, management heavily promoted an initiative called the Golden Dome. They went so far as to highlight an estimated $500 million market opportunity attached to it.
$500 million. It's huge.
Right. But fast forward to the June earnings call, and Golden Dome was quietly renamed to Halo Shield. And that $500 million revenue estimate,
Yeah.
it completely vanished from the script.
Poof. Gone.
Gone.
Did any analysts ask where $500 million in projected opportunity went?
Nobody asked, and management certainly didn't volunteer the information.
That is sketchy.
It's definitely a red flag. Additionally, their cyber mission solutions segment saw its growth outlook downgraded. Management blamed something they called the Doge effect.
The Doge effect, like the meme coin.
No. This essentially refers to sweeping reductions in government administrative services.
Ah, Department of Government Efficiency stuff.
Right. Which consequently slowed down the bureaucratic machinery required to actually award new cyber contracts.
So we have a rebranded initiative, a missing $500 million estimate, and bureaucratic friction in the cyber division. Is there anything else shifting in their narrative?
Yes, and this last shift raises critical questions about the durability of their demand.
Okay.
In the March Q3 call, the narrative was heavily anchored in geopolitical urgency. Management explicitly cited the conflict involving Iran, noting the deployment of 1,400 one-way attack drones in a single week.
Oh, wow.
Yeah, they used that specific international crisis to justify their explosive growth story. It was a headline-driven pitch designed to highlight the immediate necessity of their products.
Which, to be fair, makes logical sense. I mean, investors watch the news, and conflict drives defense spending.
It does. But in the June Q4 call, that geopolitical urgency was entirely absent.
Really?
The word Iran was never spoken in the prepared remarks.
That's quite a pivot.
Instead, the explanations for revenue timing and growth reverted to incredibly standard bureaucratic budget cycles.
Oh, boring stuff.
Exactly. Discussions about continuing resolutions, reconciliation bills, and waiting for funds to clear in the spring.
Right.
And when a core narrative hook disappears in just 90 days, you have to ask if the underlying demand is truly structurally permanent, or if it was just a temporary reaction to global headlines.
Right, I hear you. But let me push back from the perspective of an everyday investor.
Sure, go for it.
Do class action lawsuits and a few quietly changed marketing names really matter when a company has a 1.4x book-to-bill ratio? I mean, they are taking in orders significantly faster than they can fill them.
That is undeniably true.
And the U.S. Army literally just handed them a $117 million contract for P-550 long-range reconnaissance drones.
Also true.
So isn't that physical demand just too loud to ignore?
Well, the physical demand is undeniably real. Winning competitive programs of record, like the P-550, absolutely proves their hardware is best in class.
Right.
But we must distinguish between a great product and a flawless investment.
Fair enough.
Wall Street is still applying a heavy trust discount due to these execution risks.
How heavy of a discount are we talking?
Well, as a prime example, immediately after this Q4 revenue beat, UBS released a research note maintaining a neutral rating on AVAV with a price target of just $166.
Wait, $166?
Yeah.
Keep in mind, for you listening, the stock was trading wildly upward toward $186 in the pre-market.
Exactly. So when a major institutional bank looks at a 133% revenue increase and essentially says, we remain unconvinced, it proves that the negative cash flow projections and accounting material weaknesses are severely dampening institutional appetite.
Man, let's bring this all together and synthesize the deep dive we've done today, because it's a lot to take in.
He really is.
When you look at the entire board, you really have a company living in two entirely different realities.
Perfect way to frame it.
Right. On the operational side, you have undeniable top-line growth. They possess a visionary product suite that is literally reshaping how the U.S. military conducts warfare.
Yeah.
They are moving away from massive legacy platforms toward these intelligent swarms of loitering munitions linked by unjammable optical lasers.
The operational thesis is entirely intact and highly effective.
But then on the corporate side, they're constantly battling their own internal growing pains.
Huge growing pains.
You have an accounting department forced to flag material weaknesses and restate multi-million-dollar errors. You have class action lawyers circling the C-suite.
Never a good time.
And you have a business model that is destined to drain cash for the next 12 months because the sheer mechanical cost of building out that Freedom Works factory to hit that 14,400 unit goal is just astronomically high.
Right. They are caught in the messy, incredibly expensive middle of a total corporate transformation.
The messy middle.
Exactly. And that leaves us with a final unaddressed puzzle for you to mull over as you watch this sector.
Ooh, a puzzle. Let's hear it.
For years, the market has valued AVV like a nimble tech innovator.
Right.
They received a premium valuation multiple, much higher than standard legacy defense contractors because of their rapid growth and software-like potential.
Basically the Silicon Valley darling of the defense sector.
Correct. But if AVV successfully executes this scale-up,
Yeah.
if they build the physical assembly lines, secure the microchip supply chains, and actually start churning out tens of thousands of munitions a year, do they lose that premium tech valuation?
Oh.
Do they simply get repriced by the market as a traditional capital-intensive defense prime, just like an RTX or a Lockheed Martin?
Because they'd just be a manufacturer at that point.
Exactly. Because if Wall Street decides they're no longer a software innovator, but rather a heavy industrial manufacturer, their valuation multiple might compress.
Meaning the stock price could stagnate even as their total revenue continues to climb.
Precisely.
That is a fascinating paradox to end on. They succeed so well at becoming a manufacturing powerhouse that Wall Street stops treating them like a tech company and starts treating them like a traditional factory.
It's the ultimate double-edged sword.
It really is. All right, listeners, what's your take on the future of AVAV? Are you bullish, bearish, or sitting on the fence? Let us know in the comments. See you next time on the Byte-Size Brief.